Hello everybody, welcome back to my channel. So Digital Core REIT, which is pretty much a new kid on the town in Singapore, just released the first half 22 numbers. So I think there are 5 things you need to know, and these are relating to DPU, impact of rate hikes, the asset profiles, the kind of stuff they have in the portfolio. Of course, there's big news around Chanos and his big shot on the US data centers. So we'll talk a little bit about it, and subsequently the acquisitions, which I thought was quite interesting, worth talking about. It's quite interesting also because I had a chat with a friend about the REIT in Singapore, and talking about this REIT, actually his concern is not any of these 5 factors. His main concern is uh, who's the parent and parent hobo, which I think was quite funny, so I talked about it here. But it's realistic, right? It's a very big concern if you're an investor in Singapore REITs, the parentage and whether or not it's good. So maybe I'll talk about it subsequently as well. So let's go right into it. DPU. So the DPU for this first distribution is 237, but on a half yearly basis is 206, right? So if you annualize it, it's around 412. And if you look at the current share price of around 87 cents, so it's just a shade below 5% yield, right, for this stuff. And also, of course, the big news around the bankruptcy of one of its customers, one of its clients. But actually, it looks that the impact is marginal in the near term, because first of all, the customer is current on the rental obligations, at least through July, and the fellow is going through a sales process. So let's see what happens. But in any case, there's a cash flow support agreement with the sponsor. So the parent, the sponsor, is gonna guarantee the rental payments through December 23. But this is not a free lunch, right? So subsequently, this guy will have to digital core, we have to pay back this guarantee to the parent. But in subsequent years, right, I guess this gives a bit of confidence to the REIT, right, which unfortunately happened just shortly after IPO. So I think there's a bit of a support for the parent. So you can see that this is the cash flow support agreement release, and you can see that the default occurred in the property in Ontario in Canada. So upon receipt of the support, Digital Core will subsequently have to pay back the amount from 2024 to 2028 in certain periods. So it's gonna happen later. But for the near term, I think the DPU is quite assured. So this is the another big concern, which was the impact of rate hikes. Because unless you're living in Mars, you probably know that the Fed is raising rates like bananas. And you can see that the actually I think what happened was that initially after IPO, their loans were all on floating, but the manager has quickly moved to fixed half of it on fixed terms. And now because of that has gone up a little bit to 2.3%. But it's quite noticeable that the leverage ratio of this guy is really low at 25.7%. So if you look at the averages for the REITs in Singapore, they're probably around 38 to 40% already. So in contrast, this guy is actually very lowly geared with a lot of debt headroom. So I think they're probably gonna do some acquisitions. So we'll talk about it later. I was very interested though. This was probably my main focus, and that was the asset portfolio that I have. I was quite interested to see what this spin-off, no, not spin-off, this REIT, which with a parent in another REIT, what kind of assets they hold. So this is pretty much the first time it's happening in Singapore, right? That a REIT in the US is listing a REIT, a sub-REIT, a child in Singapore. So this is really funny, right? But anyway, look at it, 100% are freehold in the US, and quite surprisingly, at least to me, right? If you look at the profile of the assets, 73% are fully fitted, and 27% is shell and core. So actually, I was expecting some colo, but actually not really. I think they've opted for a more stability kind of portfolio of fully fitted and shell and core. So a bit of M&A, but mostly brick and mortar, right? The physical thing. And in terms of the customer contracts, triple net is around 63%. So all outgo is borne by the tenant, right? And then gross plus electricity for 37%. So if you look at the profile of the lease expiration, it's pretty much long lease, right? 47% is post 29, which again is a function of the property type, right? It's mostly fully fitted and shell and core. So the colo is not a big part of this portfolio for the bank. So you will see near-term expiries over here and mostly long tenures. So I think this initial portfolio was set up to ensure stability of the DPU. If you look at the if you do a comparison, right? Because I was thinking, if you're gonna invest in a data center REIT, we have quite a few options now in Singapore. You can do MIT, you can do Capo DC, who is 100% DC, right? And actually, maybe you can also do a Sanders REIT, right? Who has done a little bit of data center. And of course, you have this guy now, who is a new guy, but all in DCs. So you have like 4 options to choose from, right? So what's the difference? So actually, if you look at it, right, in MIT, Maple Tree Industrial Trust, they did an acquisition of 29 data centers, I think last year or something, for $1.3 billion. And if you look at the profile of the data centers that they bought, and these are all in the US, right? Because it's Cedar Realty. So look at it, powered the data centers is 64%, and fitted is 36%. So actually, the profile of the portfolio that MIT bought is pretty much similar-ish to the profile in over here. So it's like not so much emphasis on the M&E. There's M&E components, of course, because they are data centers after all, but they are not co-location data centers. So the profile between the portfolio that the MIT bought is pretty much similar-ish to the stuff that you have in digital core. At least somewhat similar. So you see, it's powered shell and fitted, right, for MIT, and over here is fully fitted and shell. So it's quite similar. The proportions are different though. If you look at the profile that the Ascendance REIT bought in 21, so Ascendance REIT bought 11 data centers. And interestingly, right, they bought it from Digital Realty Trust, who's the parent, the sponsor of Digital Core, right? So it's funny because the guys are buying from the same source. So Ascendance REIT bought the stuff for $900 million. And if you look at the profile of what they bought, actually it's quite different, right? Because 58% are the shells and the fully fitted. And actually there's 42% which are colo. So if you look at it, MIT and Digital Core seems to be, at least as of now, focusing on more stability and doing the shell and core and fully fitted. And Ascendance REIT has bought a portion of it in colo, right? And if you look at the profile of the DCs in Capo DC, it's also a mixture, right? You have colo and then you have fully fitted and shell and core. So it looks like Digital Core and MIT are over here in terms of stability, and then you have AREIT and KDC who have some elements of co-location. There's a opportunity to live rental if the market conditions are right, but of course at the expense of stability, right? Because there's more volatility if the near-term rates go down. So there's a fair bit of difference. So if you look at the portfolio in detail, which is good because actually the portfolio is pretty small, only 10 properties, right? So if you look at it, the shell and cores, they don't have the IT load, and then the IT loads will come from the stuff from fully fitted. But of course, the stuff with M&E come at the higher portfolio valuation, right? So if you look at the biggest one at Hastings Drive at $318 million, that also comes with the higher IT load, right? But in general, it's kind of not high powered, right? So like 14 mega, 10, 6, 6. So not crazily huge. So look at the customer profile. Well, not much you can see, right? But I think there's a fair bit of concentration. Look at it. So 60%, right, comes from 2 fellas. And then 80% come from the top 3 fellas. So I'm not sure who these fellas are. But there's a fair bit of concentration amongst customers. So of course, this guy Jim Chanos, right? Fund set up to take short positions against US REITs. So he's saying that there's big guys like Amazon, Facebook, Microsoft, they would go from being leasing data centers to owning data centers, and from tenants they'll become competitors. So I think there's a truth and there's also not truth in what this guy is saying. I think there are people, there are tenants who will ultimately turn out to own their own data centers, especially this guy called Amazon. So you've seen Amazon, right? Initially, it's an e-commerce guy, and then he built out its own logistics network to do the deliveries. So now that they have AWS, which is the fast-growing components in the business, I won't be surprised if Amazon turns out and build a huge portfolio of data centers to support its AWS business and therefore become a competitor. But at the same time, if you look at guys like the social media guys like Facebook, Snap, well, like for example, Facebook or Meta, they are throwing like billions of dollars in the metaverse, right? Trying to create the new OS and the future for going forward. I will be very surprised if these guys will choose to allocate their capital by building data centers instead of hiring talents to help build a better platform, a better product for customers. So I think there's some truth and there are some untruth as well. But overall, the main thing is about the demand for whether or not the pie can grow, right? So if the pie for data centers and data and storage and cloud and edge can grow, then data centers will have the space to expand as well. And it's all about the operators' ability to upgrade their properties to cater to the clouds and hyperscalers. So, well, I don't think it's very right to short everybody all data centers just because of this concern. But some guys who are not well managed will suffer. Some guys who are well managed will not suffer. So that's about it. So, and this is the last point actually, which I think is very important, which is the acquisition plans going forward. Like what I mentioned just now when my friend said, hey, the parent holds stable. It's very true, right? If you look at the REITs in Singapore, in general, you have three categories, right? Those with good parents, those with so-so parents, and those with really rubbish parents, right? I won't say who is who, but if you look at the REITs managed by Maple Trees, for example, well, very well managed, right? And you can see that the price to book ratio is always premiums. So you can see the effects of the sponsor. So I think the main concern for this guy who's a new listing is how's the relationship between Digital Realty Trust, the sponsor, and Digital Core, which is the listing. And I think the acquisitions going forward will be very important to see whether or not they are able to make accretive acquisitions or not. If you look at it, they actually spell out some plans for the acquisitions. There are three target assets, one in Frankfurt, one in Chicago, and one in Dallas. So total volume is around, total size 150 to 650, depending if you buy one or you buy all three. So that's the size you're talking about. Pretty young though, 5 years, below 5 years. So if you look at the gearing right now of around 26% and 200 million of debt headroom, and even at 200 million, right, they only hit 35%. So far distance from 40%, right? So they're probably able to use debt to fund like one acquisition of 150 million. And if conditions are right and they trade above book or something, maybe do a bit of equity raising, do a two. And if conditions are really right, they might do all three, right? So as for the details of these three, it's difficult to say, right? Because they don't give any at least I can't find any details about these three assets, whether or not whether or not they are co-locations or fully fitted or shell and cores and the NPI yields and stuff. So I think the main concern and the main thing markets are watching out for is the details on the first acquisition and whether or not it's going to be accretive and stuff. And actually, they told you, right, in this presentation, they're expected to sign a purchase agreement by third quarter of 22, which is coming soon. So all eyes on this acquisition, because that's going to set the tone for the future. So we've come to the end of this video. If you like what you saw, remember to subscribe, like, share, and comment. So I'll see you guys very, very soon.